After 6 days of non-stop one-way rally, the market is a little more mixed today. While the Nifty is trading above the mark of 23,700 and it crossed 23,800 intraday, the mid-caps and the small caps are now trading in the red.
Trump threatens a 25% tariff on any trade with countries that buy Venezuelan oil and gas. This would impact China and probably India as well. Analysts at ICICI Securities, though, do not see a major impact for India or Indian companies as the quantum of imports from Venezuela is low.
The SEBI has eased disclosure norms for smaller foreign portfolio investors, also announces the formation of a high-level committee to review corporate governance norms at SEBI. Tuhin Kanta Pandey, the new SEBI chair, in response to a question, says they will examine the NSE IPO matter but did not commit to a specific timeline.
The management of Electronics Mart of India and the heads of Retailers Association tell CNBC-TV18 that consumer spending in the fourth quarter has remained muted. While EMIL points out to some same-store sales growth of 5 to 6%, RAI says the industry has seen near zero growth in apparels and very low growth in electronics as well, whereas food delivery, or rather food and grocery, remain at mid-single digits as well. The recent stock market decline has a sobering influence on sentiment. You're watching us here on Halftime Report on CNBC TV18. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Horma Svatakia. Doing okay-ish for the frontline index. After a big rally, it's paused for breath, maybe some sort of consolidation at higher levels and maybe some bit of profit booking that we are seeing for the mid-cap end of things as well. Where is it that the most amount of underperformance apart from mid-caps is? We have it on Nifty Bank, which is actually, very close to its, previous all-time high, sub 5% away now. It's above all the important moving averages and dips are being bought into. That's a positive. And the second part is that we have some weakness coming in from, erstwhile outperformers, which are now seeing some bit of profit booking once again. The Nifty Bank has been buoyed lower by IndusInd Bank, which continues to move lower. What's done well, however, is IT, which after earlier underperformance is now seeing some bit of an outperformance as well. So, Hormas, seems like it's par for course.
Par for the course, actually, absolutely. And it after a move like this, where you have gained almost 2,000 points, right, in a very short span of time, some bit of consolidation is warranted. But the Nifty still holding on to gains of around 50 points. At one point was up 200, of course, but still around about levels of 23,700. A lot of the movers in the broader markets, though, are the ones that are grabbing the headlines. Mangalam just mentioned IndusInd Bank, the only one that is still in the F&O ban today, but still continues to trade with losses of around 4.5-5% in today's trading session. Among the top losers on the index, Swan Energy is another one, 5.5% lower there as well. And these quick commerce names as well, Zomato is down around about 4.5% as well. We'll talk to Mangalam more about this during the course of the show. But the sector that's doing well today, as Mangalam just mentioned, is IT, and that's bucking the trend, if you could call it that. UBS is bullish on the sector. It's come out with a note saying that it is seeing more upsides than downsides for the sector in FY26. Rima has details on that. Over to you, Rima.
Indeed, UBS says there's more upside in store for Indian IT compared to downside because stocks have corrected so much. Indian IT stocks are down 15 to 20%. The valuation multiples of these stocks are down anywhere between 12 to 20%. So yes, uncertainty has increased. The macro has gotten tougher, but their conversation with the IT companies suggests that the impact on tech spending has been marginal. So on the whole, FY26, they acknowledge will be tough. They're lowering their revenue growth forecast by 5 to 7%, but they're still saying that FY26, even after, the expected cuts, will be better than FY25, and therefore there is a case for the valuation multiples, which got compressed over the last 2 months, to retrace a tad bit, at least go back to levels of FY25. So they're expecting a rebound of 5 to 10% for the IT sector in the near term. Also, while, there is uncertainty because of the US economic slowdown, etc., there are certain counterbalances in the form of, Fed rate cuts and corporate tax rates. So therefore, they believe FY26 will be better than FY25 for most of the Indian IT companies. And the table will come up for you where, they show the revenue growth forecast for the coming year, except TCS. All the others will see a better growth. Also on the valuation front, they're saying that, the valuations, because of the correction that we've seen, are trading below than their 5-year averages. So TCS, for instance, is trading more than 1 time standard deviation below its 5-year average. So therefore, UBS likes TCS, Infosys, Wipro, HCL Tech, all buy calls on these large cap IT names. It's only at Tech Mahindra where they've got a sell call.
All right, Rima, thanks a lot for that. With that, let's shift to a space which is doing a lot better today, which is the cement space. UltraTech is the top Nifty gainer. In fact, a bunch of cement stocks are doing well, and that's on account of a UBS note that has come in where there has been an upgrade. Nigel joins in with all the details out here. Nigel.
Well, that's right. UBS has gone ahead and they have upgraded the cement sector. They believe that the rough patch is coming to an end. And so they've upgraded UltraTech, Ambuja, Dalmia to buy. Remember, UBS has a negative view on the sector itself all the way since July 2023. The key reasons they cited at that point of time was rising competition, the demand slowdown because of the general elections, and also price competition because Adani had entered the cement space. But now, UBS, they have turned positive and they anticipate the earnings upcycle to emerge from this fiscal, that's FY26, strong EBITDA growth over the next two fiscals. Their positive stance is backed by demand revival, which will be driven by housing upcycle and the revival in government capex. They're also pointing out that the structural cost savings is going to help drive margins of the sector higher. And they believe that pricing could bottom out after the sharp fall that we've seen in the first 9 months of FY25. The sector consolidation has been led by two big players, that is UltraTech as well as Ambuja. The reasons for upgrading various stocks, and the chart should come up for you on the screen. For UltraTech, they believe that the company has shown strong execution in tough times, have led industry both in growth as well as on margins. Their top pick, however, is Ambuja. That's because of the higher growth and the lower valuations. On Dalmia, they've done a complete U-turn. They had a sell rating, now they've upgraded it to a buy, while they maintain their positive stance and the buy rating that they have on ACC because of supportive valuations and industry tailwinds. Put all of this together, UBS, after close to 2 years, they have turned positive and constructive on the cement space. Back to you guys.
Strong day indeed, and a strong report as well from UBS. Nigel, thanks a lot for that. We take a short break, but just before we do that, here's a small programming note for our viewers. CNBC-TV18 India and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. You can scan the QR code now and submit your entry for the SME Champion Awards Season 2. Welcome back. Now, market regulator SEBI has eased its disclosure rules for foreign portfolio investors after Chairman Tuinkanta Pandey chaired his first board meeting yesterday. We are now being joined by Sunil Badala, the national head of KPMG, and we are also being joined by Tejas Desai, the partner and leader of wealth and asset management of tax at EY, and Surbhi is joining in on the conversation as well. Surbhi, good afternoon.
Hi, Hormas. Good afternoon. I mean, just a bit of a background. This obviously, it sounds like a, good enough relief because what we have is that, you had to make additional disclosures if you were an FPI in India. If your total AUM was 25,000 crores, or if the total exposure of your AUM, more than 50%, was in one single corporate entity. Now, this just goes back in time, just to revise our viewers' memory, back to August of 2023. And these new disclosure norms came in at the height of the entire Adani saga, when the stock prices were literally crashing. So from then, we've traveled a very long way. There have been several changes as well, several extension of the deadlines as well. And more importantly, there's been a carve-out that SEBI also allowed that, while you hit these thresholds, if you fulfill a certain set of conditions, then you still not have to make those additional disclosure requirements. So what has happened today is that one of those conditions, the definition has been changed. The threshold has been hiked, which is the first part of that definition, which was, the total assets under management that an FPI has in India. So instead of 25,000, now that limit has been hiked to 50,000. So let's try and find out to what extent does it help? Does it allay all the FPI concerns or not? Sunil, let me open the floor with you. That's really the question. Does it put to rest completely the ghosts of the August 2023 circular?
No, Surabhi, so as you correctly mentioned, this just addresses one element of the overall situation that we have. So obviously this 25,000 crore limit has been raised to 50,000, which anyway should have happened because SEBI itself has noted in the circular that the trading volumes actually have become more than double. So what was 25,000 crore way back in 22-23 obviously is much more than 50,000 crores now. So, but still, that's a good move. So yes, until your AUM in India is 50,000 crore, you don't have to worry about disclosure requirement. Having said that, of course, there are various other triggers where these disclosure requirements will get kicked in, and therefore the fear of FPIs identifying the natural person as beneficial owner of the investing entities actually remains in many cases. But yes, as far as this relief is concerned, I think it's a welcome relief.
And how big a, Sunil, a relief is this? I know it's hard to get numbers on it. I remember when the original circular came, I think SEBI itself had made the contention that almost 90% plus sort of FPIs will be exempt from the purview. Only a very few handful of FPIs will be impacted by the requirement of additional disclosures. Now with the threshold going up to 50,000, is almost everybody exempt?
I don't think so. I think the percentage will probably not undergo significant change. So whilst on the one hand what SEBI said was correct, that more than 90% FPIs were anyway outside of this. But as I said, because of the trading volumes going up, I think whatever 5-6% of the FPIs which were getting impacted because of the volume being higher than 25,000 crores, I think my sense is that many FPIs will still remain under the radar. Although I don't have the concrete data, but I don't expect any change in that.
Okay, fair enough. Tejas, let me get your perspective on this as well. So one condition has been relaxed. The other condition stands, which is that if you own more than 50% of your AUM is in one single corporate group, then you still have to make disclosures. And let's not forget that there is also that exemption list, right? Which over the course of the last 15 to 18 months, they also had a carve out that if you're a pooled vehicle in a jurisdiction which SEBI recognizes, then perhaps you can be exempt from these higher disclosure norms. So we come down to the same question. Are there still outstanding issues? Are FPIs still being impacted despite this relaxation?
Yeah, so Surabhi, two things. One is that the August 24, 2023 circular basically laid down two criteria for FPIs to provide granular ownership details. One was what we call the size criteria, which is what you alluded to, the 25,000 crore becoming 50,000 crores now. And the second was the concentration criteria, which basically means that if an FPI holds a concentrated position in a single investee company, then he has to provide the granular details. Now, that criteria, as you rightly said, has not been relaxed. And SEBI's intention is that is potentially perceived to be a violation of what we call the minimum public shareholding norms or the takeover regulation. So SEBI is not relaxing that criteria, and I think rightly so. It is relaxing only the size criteria. So any FPI still has a concentrated investment in a single portfolio company is bound to provide the granular details. But having said that, I think it's a welcome relief, to increase the threshold from 25 to 50,000 crores. Again, like Sunil said, we don't know the exact numbers, but it does provide some relief for the FPIs. And to your point on the exemptions, yes, there have been significant exemptions that SEBI has provided already in its August 24 circulars, which is, applicable to government entities, government-related entities, ETFs, listed funds, university funds. So there are a host of exemptions which were already provided. Those continue to stay, and I think those will provide meaningful relief. And I think that brings us to the point that, look, I think this will rightfully exempt, almost 90% or more of the FPI population. There will be that 10% who will continue to have to comply with the granular ownership details.
So, Tejas, with this additional relaxation, and plus, like you said, they've already, announced a whole host of exemptions. Funds which will be exempt even if they hit the threshold. So, all put together, should we expect greater inflows? This is not a question for today, but generally, because the framework is being made a little more liberal, should we be expecting this overhang to end and then therefore more inflows?
No, look, I think the increasing limit is a good thing. It will certainly be welcome. But I think FPIs have to recognize that India is an ID market. India will demand more data from them as compared to other geographies. I think that is not going away. That is something that is here to stay. But any incremental relief is a welcome step, and should go some way in increasing ease of doing business or ease of investing into India.
Sunil, your thoughts on this?
No, so I think I agree with what Tejas mentioned. See, look, Surabhi, to actually expect a greater inflow obviously will depend on a lot of other market dynamics, but certainly this is a deterrent which I think FPIs had. So to that extent, I think this is a welcome move. So I mean, let's just simply take an example of let's say an FPI with its investor group. Their ability to invest from 25,000 crore has suddenly gone up to 50,000 crore. So obviously, we have provided them an enabling framework to actually double their investments on an immediate basis. Now, whether they will take advantage of this framework or not is obviously going to depend upon a lot of other dynamics. But certainly there is a framework, and therefore to that extent, I think this is a great thing.
Okay. Final question, gentlemen. When we talk to several foreign investors, and I always remember Chris Wood because he's repeatedly made that point, talking about how it's difficult to register in India. It's still difficult to do business in India as an FPI. Some people argue on taxation. I'm leaving tax completely out of this, but purely from a disclosure and regulatory perspective, are we there yet? Or what are the other aspects which are still trouble spots where you would perhaps want to see more focus from the regulator? Quick, last word on this, Tejas.
Yes, since you brought up the tax issue, Surabhi, I do want to call out that I think March 24 has been a good day for FPIs investing into India. There has been a relaxation on the tax front in Section 9A, where they have relaxed one of the conditions. Section 9A was essentially introduced to give a boost to asset managers to relocate to India, to come back to India. This was Make in India for the asset management industry. And I think they have relaxed one important condition by omitting the word indirectly, which basically required asset managers to trace granular ownership. So the two issues are interconnected. This is all about granular ownership, whether it comes from the SEBI regulations, whether it comes from the tax law. And I think if you look at the two together, then I think yesterday was a good chapter in the history of Indian FPI investments. I think I would leave it at that.
Sunil, you concur? Just quick 30 seconds. Any major outlier issue that still needs to be addressed?
So as far as this limit of 50,000 crores and the concentration limit of 50%, when we talk about granular details, means Surabhi, I have to provide details of each and every investor who's the natural person, regardless of a threshold. So, for example, let's say there's an individual who holds even one share in the investing FPI entity. I need to provide details of that. So maybe some kind of a percentage threshold, which is there, like in the other disclosure requirement, where it is like 10% or 15%, depending upon whether it is a corporate entity or a partnership. I think that kind of a threshold we can consider.
Okay. All right. Some more suggestions, but I guess both of you welcoming the fact that at least there's some ease that's definitely coming. The threshold limit being straight away doubled from 25,000 crores. Gentlemen, thank you very much for weighing in on what is seen as a positive development, largely for FPIs looking at India. Back to you guys.
All right, a step in the right direction, though some distance to cover as per these guys as well. But nevertheless, we will take that with both hands. Take a short break on the other side. Keep an eye on the markets, though. It's fallen off the highs. Nothing really worrisome. Just one of those dips after a big rally that we've seen. On the other side, Sachidanand Uttekar of Trade Bulls joins in with some trading strategies. Welcome back. Like we pointed out, key indices have fallen off the highs, though a couple of stocks doing extremely well. Trent, as you can see at the bottom of your screen, has picked some pace. Remember, it's been an underperformer. It's down about 40% from its high, so at lower levels, maybe some bit of purchase is what it's seeing. But good time to get in an F&O perspective, just 2 days ahead of expiry. The Nifty Bank and the mid-cap index. The mid-cap index is the one which is seeing a fair amount of profit booking. The Nifty Bank as well, after having crossed important levels, all important levels, and going within 5% distance of a 52-week high, seeing some bit of profit taking. Interestingly, the advanced decline ratio as well has, after a very long time, moved into the favor of declines. Is there a cause for worry? Perhaps not. It's just the last two trading sessions. We had pointed this out yesterday as well, that maybe the up move from here on may not be as smooth as what we had seen earlier itself, and that was visible in the fact that the India VIX moved higher despite the market surging in yesterday's trading session. Today is no different either. The India VIX is up around 2% odd. Where does the Nifty go from here? Not much lower. Why do I say that? Because on the way up, while there is some writing at the 23,800 call telling you that 23,850, 23,900 could be some bit of resistance, at the lower level, 23,700 put writers haven't budged. In fact, 23,700 put writers still active for a premium of 120 rupees, telling you around 23,580 to 23,600 could be the supply, could be the demand zone for the market. And every time the market moves towards those levels, it would make prudent sense to invest or buy in that dip itself. On the way up, if the Nifty does cross that 23,850 mark, there are punts which are being made at the 24,000 level itself, which is closer to the 200-day moving average on the index. The other heartening fact, despite the correction that we've seen from the top today, is that yesterday's decline was also, or rather yesterday's surge also meant that the put-call ratio overheated to 1.21, and now today's decline has cooled that off as well, leaving further headroom for growth for our markets from here on itself. Just keep an eye out on Hind Copper, though, from the individual stocks. It's one of those stocks which may give Indus company tomorrow by entering the F&O ban. It is the one that actually exited F&O ban yesterday, may re-enter that.
In ban one day, out the other. It'll be interesting to see once IndusInd Bank too comes out of the ban sooner or later, as we are heading towards the monthly expiry as well. But Sachidanand Uttekar of Trade Bulls is joining in on the show now. Sachidanand, good afternoon. Thank you for joining in. What are the stocks that you are recommending this afternoon in this volatile market?
Good afternoon, almost. Good afternoon, Mangalam. I think this correction that we have seen so far is very healthy. In fact, even after 7 days of a rally, Nifty was indicating some headroom towards 24,000, and I think that headroom still remains intact. On the lower side, I think today's built-up is again indicating that 23,600 looks like a decent support, which has been elevated. So I think closer to that is again a good opportunity to create some long positions. We are expecting that eventually we may see this particular move getting exhausted towards 24,000. So I think the reward to this opportunity is again bright. Any declines towards 23,650, 600 would be a good level wherein some long positions can be committed. The stop loss for the trade should be placed at 23,520, and we may see a final swing towards 24,000. Now, if you look at the entire rotation, banks are something wherein there is some profit booking, but IT stocks have started performing. So from this particular space, Coforge has registered a fresh breakout from this consolidation. Now, if you look at the 60 minutes chart, it's a classic rounding bottom formation. It has also, crossed its 50 DEMA convincingly. It's an open interest hurdle which has been crossed at 8,000. So we are expecting this momentum to continue towards 80 to 50, and that's why we are recommending building fresh long positions here. One can keep a stop loss at 78.80 on a closing basis for a pattern target of around 8250. The other stock which Mangalam has already highlighted is Trent. Now, after a good underperformance and consolidation, the stock has started trending above its 5200 hurdle. Now, if you look at the trend indicators, there is a positive crossover on its RSI, and plus there's a good strong convergence on its 5 and 20 exponential moving averages, which is again a sign of momentum. So we are expecting this particular rally to continue towards 5450, where its 50-day exponential moving average is placed. The reward to risk is again healthy. One can keep a stop loss at 5120 on a closing basis, and some aggressive long positions can be considered for a final target of 5450.
All right, Sachi, thank you so much for joining in and giving us your call on the index and individual stocks. With that, we'll take a short break. On the other side, we have the management of Symphony joining in to discuss demand trends and the outlook going ahead of what promises to be a very hot summer.
Welcome back. We're just about to step into the month of April, but just before that, we've already witnessed some extreme heat already here, at least in the city of Mumbai. But how is the demand trend shaping up for cooling products as a result of this? We're being joined by Rupesh Shah, the Managing Director of Corporate Affairs at Symphony. Mr. Shah, good afternoon. Thank you for joining in. How has the demand trends shaped up in the month of March in specific because of the rise in temperatures across the country? I'm referring to this brokerage note, which is saying that there has been a strong surge in demand for residential air coolers from mid-March. What are the trends that you are observing on the ground? Mr. Shah, I think you're on mute. You'll have to unmute yourself.
There are very strong trends, very buoyant demand, and on top of it, the 17 new models which we have launched have also received overwhelming response, and even adjacent category also is receiving good response. So as of now, in current quarter, we are heading towards very strong growth and performance.
On mute, Mr. Shah, your tie, which is a bright summery tie with flowers, was telling us the story that this is going to be a good summer. I just wanted to know, when you say that there is buoyant demand and strong performance that is expected in the current quarter, if you could put some numbers to it versus last summer to this summer with the 17 new models that you've launched in India, what kind of growth can we see in the cooler business? And at the same time, I presume with these new models, you would make better margins as well. So what can we expect in this summer versus last year?
So right now I'm talking about March quarter, and of course, good summer is expected. So we are hopeful that June quarter should also be good. However, in March 25, already on a high base of March 24, we expect to deliver as per the going so far, strong top line, strong profitability, and better margin.
Could you define strong in some numbers? Is it plus 20%, plus 30%, mid-20s, mid-teens, low double digit? If you could just, I'm not asking you for a specific number, but just a range which, the street understands.
It's difficult to quantify because of our IR policy. But I'm giving you adequate guidance that we are heading to on a standalone basis as well as on a consolidated basis for the quarter and year as a whole. This should be a very strong performance, and including better profitability on new models.
Mr. Shah, at the end of the third quarter, you had mentioned that a large part of your unbilled advances, which were at the end of the third quarter, were for newer models. Has there been any recovery on that front? And as a result of which, do you see better margins as well this time around compared to last year, as well as compared to the previous quarter as well?
Yeah. So as it was guided post-December quarter, there was large unbilled advances towards new models. So as scheduled, as decided and as guided, new models production have commenced well in time. They have been billed and they have been delivered. So of course, that sale will be recorded in the current quarter. Secondly, as guided, new models do command better pricing and better margin. So overall, mix of new models and old models should improve the profitability.
What about the overall business for the next year? You've given us a sense into March, and understandably, because of your IR policy, you can't, give us any more details. For FY26, given the early trends that you're seeing for summer, what is the kind of growth that one can expect? If you could give us a sense in the first half of this year versus the second half of this year at least, because you have visibility, I'm sure, for the next few months.
So as per all the signals, there seems to be very strong summer, overall market sentiments, trade channel sentiments, and of course our team sentiments are very buoyant. And if so, we do expect 25-26 should register strong top line and profitability growth on 24-25, keeping in mind 24-25 itself will be a high base, considering likely very strong quarter performance as well as earlier performance bearing December quarter.
Would you grow faster than the industry? Because then that would imply that you are gaining market share.
We are growing and we should grow faster than industry.
Okay, and what rate is the industry expected to grow at?
So, on a CAGR basis rather than YOY basis, industry is growing in the range of 10 to 12% in last 3-4 years. Our CAGR growth is certainly higher than that.
One final question.
Will continue because the kind of the variety of the models, price points, and we are addressing every segment, and more importantly on account of several strategic initiatives which we have taken to penetrate in semi-urban and rural market in last 3-4 years. Apart from that, digitization, e-commerce, D2C, that's really bearing the fruit, and that's quite evident as it was witnessed last year, and I think we are gaining further traction even in that respect.
All right, we take that point. Thanks a lot, Mr. Shah, for joining in and giving us all those details, though we would have liked some more conversation around your international subsidiaries as well. I remember climate tech is something that you said that you will see some improvement in the next financial year, but we'll leave that for another conversation. As of now, it looks like this summer would be fairly hot for us and very bright for your cooler business as well. Thank you. Wish you all the best for March quarter as well as June quarter. With that, we'll take a short break. And as we do that, let's give all our viewers some good news. The India Business News Leader is now just a click away, which is the CNBC-TV18's all-new app, which gives you access to instant, breaking news, in-depth analysis and financial world updates, all of them at your fingertips itself. What you can do is you can download the app from either the Apple Store or the Google Play Store, or just scan this QR code, which is up for you on the screen on your phones, and that will redirect you to the link that takes you to this app. Welcome back. Let's get you some value plus on what's taking place in the internet commerce sector, the e-commerce sector. And this is a note which is coming from Jefferies, who hosted Reds here, who are basically strategy consultants for the internet commerce companies. And this is their key takeaways from their business, which one can look for in the e-commerce space as well. They expect the sector's growth to moderate. In the last 4 years, it's actually grown at a CAGR of 30+%, which could moderate between 20 to 25% over the next 5 to 7 years. Quick commerce, value commerce, and beauty and personal care, however, have performed fairly well. Remember, almost 85% of the quick commerce gross merchandise value is concentrated in the top 8 metros. So the belief that it's, only a metro phenomenon stands validated out here. So how it expands beyond that is something we have to look at, because even of this 85%, 75% is concentrated just on 3 metros, which is Delhi, Mumbai and Bengaluru. Value commerce, however, is growing over 20% last year, expanding beyond fashion, entering into home and beauty products as well. Why is this important? Because in beauty and personal care, e-commerce is seeing good traction across both premium and value segments. We've seen premium outperform anyway, but now maybe is there a case for Zudioization of beauty and personal care in the value segment, specifically in the e-commerce space or not, is something we'll most definitely keep an eye out on, because value players are looking to mimic the local market in terms of assortment, value offering, and they are seeing some strong traction as well. Add to that, players are also looking to unlock further growth in new opportunities such as fast and value fashion online, because this is a proof of concept that has worked offline already. So can they replicate that online or not is the big question. So key takeaway, while overall e-commerce is likely to moderate in terms of the growth path as against what it had done in the last 5 years, you have a couple of sectors which are doing well: quick commerce, value commerce and BPC, beauty and personal care. In quick commerce though, it's still a metro phenomenon. Let's see how it expands beyond that itself. With that, we'll take a short break. On the other side, Manisha Gupta joins in with Peter Maguire of trading.com.
Joining us on the show now is Peter McGuire. He's CEO Trading.com. Peter, hi, thank you for joining in. And I want to start with the crude oil prices because we've seen a percentage point of gain overnight. We're trading at a 3-week highs. I mean, as is being said, you can't teach a lesson to countries and then also hope that the crude oil prices will remain stable or lower. I mean, that seems a bit contradicting, won't you say?
Absolutely, Manisha. Good to see you. I think, so many different components still working through. Naturally, we're a week away from President Trump's introduction as far as the tariffs on the 2nd. And also now, which is the wild card, these secondary tariffs have been introduced. And this invents a new trade weapon. And that's the issue. Now, Venezuela, as we know, exports greater than 40% of its crude to China for oil and gas. And this is going to be a really heavy hit on China. That's who it's directed at. There's no doubting that. So Venezuela, naturally, that's the other side of it. But this is very dynamic. And these geopolitical, I suppose, strategies are going to be fascinating how they play out over the next week or two.
And Peter, apart from that, we are on to a countdown on 2nd of April as well. The reciprocal tariffs is something that everybody seems to be talking about. And then, of course, retaliatory tariffs and etc. Would you say that the next 1 week is going to be very, very volatile or important in that sense?
I would think so, Manisha. I feel as though that you'll see an interesting what's going to be, I think, how it plays. First off, naturally, the impact as far as US dollar. Secondly, stock markets and the likes of gold as a safe haven. And it's bounced heavily today. It's up back at, 3,050. So all of those components and then volatility across, naturally, the energy sector. And I think how stocks play and bond yields, they're going to be the next part of it. So, yeah, there's no doubt about it. We said it'd happen. There's plenty of action under President Trump.
There is. So since you talked about gold, what's your sense on that? We've done an all-time high of 3,057. We are holding around 3,015 right now. There is some profit taking. And that also is because we've seen the US dollar index gain to a 2-week highs right now. For the near term, there is a bit of a profit taking. But going forward, would you say that the gold still has it in itself to make further all-time highs going forward for the rest of this year?
Absolutely, Manisha. I mean, we got 9 months to run, so I don't think that's going to be too hard to achieve. And the way it's going, I wouldn't be surprised that it probably does it this week. I think because volatility working through the market, yes, it's profit taking. Yes, it's going to be volatile, but these big breakouts on either side, there'll no doubt be resistance. I think probably around about that 29.50 sort of number if it was to hit it, as support, I should say, but the resistance to the upside. Let's see where it rolls. And I truly do think that we're in for some very interesting times over the next week.
Peter, any target that you would want to put on in gold on the higher side?
It's got to be 31.50 to look at, Manisha. I want to go there first off. 32.50 is really the line in the sand, but I'm probably a little bullish there at the moment. I've got many investment banks and the biggest banks in the world are saying between 3 and 3.5. So we're in that, but I think it's going to be there a lot quicker than everyone's thinking because the ramp up that we've seen since January 1 has been monumental. And that, I think that that strength and the overall support is not going to wane anytime soon.
Peter, what's also your sense on the metal prices? Because copper clearly has been an outperformer. And then, of course, we've seen supports come in for aluminum. Cobalt is up by 38% in this year. The metal is clearly taking it firm.
Yeah, I noticed that some of those, the other metals, cobalt was just a scream. But it's only just nudging 10,000, copper at 99.56 on the LME. It's going to take, I think, again, it'll take it out this week, that psychological barrier of 10,000, Manisha. It's been very, very bullish. And aluminium, I think that'll probably have a little bit of a run as well, and zinc. So tin's been a strong market. And all of those metals, I think we've got probably, second quarter could be a very dynamic quarter for industrial metals.
Anything as an outperformer that you see continuing for second quarter as well?
I think everything is going to be volatile, and I think that's going to be. I listened to the likes of Treasury Secretary Scott Bessent. I listened to Howard Lutnick, Commerce Secretary. These guys have got their finger on the pulse, and you've got to appreciate what their viewpoints are. And I'm really thinking that we're going to see one, volatility, and secondly, opportunity leading into Q2 up till start of Q3.
All right. So clearly, Hormuz, as I say, stay invested when it comes to metals, not just base metals, but definitely precious metals.
Oh, absolutely. And that's why they're precious, right? This is gold, the kind of moves that gold prices have seen. Peter, thank you so much for sparing time and joining in. Manisha, thank you for joining in as well. With that, we call time on this edition of Halftime Report. Thank you so much for watching Business Lunch for the next 30 minutes.